Are pensions still worth it, or are they just a relic of a bygone era? Now, I know this sounds a bit weird coming from a firm that calls itself the pension specialist, but it's a question I am hearing quite often at the minute. With the cost of living skyrocketing, taxes not getting any lower, and pension rules constantly shifting, it's no surprise that people are wondering, is putting money into a pension still a smart choice? Well, stay tuned folks, because by the end of this video you'll know exactly why pensions are still one of the most powerful tools in your financial armory and how to make the very best of them. I'm going to show you what's changed and what hasn't, and most importantly how to avoid the common mistakes that could cost you thousands of pounds. A quick heads up before we get started: if you're watching this thinking it's probably time to get serious about my financial future, just a little reminder that we are here to help, and you can book a free financial review with our expert team by clicking the link in the description. Normally worth over £800, it's completely free for you. There's no catches, just clear, helpful advice to guide your financial journey, and there is no obligation to become a client. Now let's be real. I hope you're watching this because your future matters to you. Well, whether you're 25 or 55, one thing is certain: unless you plan to work forever, retirement will arrive for you at some point. You'll need to replace your wages when it does, and that's where pensions can step in. But are they still fit for purpose, or are they outdated? Well, with market swings, tricky tax rules, and worries about government cuts, it's no wonder people are starting to get a wee bit skeptical. Now here's the deal: pensions can still work brilliantly if you use them correctly, and if not, you risk leaving serious money on the table. Now get this folks, there's around £31 billion sitting in forgotten pension pots across the UK, 3.3 million lost accounts. That's an average of £9,500 each, and even more if you're 55 plus. Now it's shockingly easy to lose track, especially if you've job hopped over the years, and let's face it, in this day and age most people aren't with one employer all their lives, are they? And it's not just lost pension pots, nearly half of employees miss out on free employer pension matches. Free money left unclaimed. So today we're going to fix that, and with changes announced in the autumn budget in 2024 last year, those missed opportunities could cost you even more. Tax-free lump sums, inheritance tax updates, and higher national insurance contributions all have the potential to impact your pension strategy. So stick around, because I'm going to show you exactly how to adapt to these changes and avoid making costly mistakes. Right, let's get back to basics for a second. What exactly is a pension? Well, a pension is a long-term savings plan designed primarily to fund retirement, but unlike a regular savings account, pensions come with huge tax benefits and in many cases free money from your employer. There are three main types of pensions. There's the state pension. This is what you'll get from the government once you hit a particular qualifying age, but here's the thing: it's barely enough to live on for most people, and it covers only the most basic costs. Next, we've got workplace pensions. These are set up by your employer, and often they'll contribute alongside your own contributions, sometimes even matching whatever you put in. This is free money and something you definitely want to take full advantage of. And within workplace pensions, it's worth mentioning defined benefit schemes, or final salary schemes as they're commonly known. These are increasingly rare but incredibly valuable and useful. Instead of basing your retirement income on how much you've saved, they promise a guaranteed income for life, usually linked to your salary and the length of your service with an employer. It's a gold standard pension in many ways because it takes the guesswork out of retirement planning, and if you're lucky enough to have one, it's worth its weight in gold, and it's definitely worth getting advice on what you should do at the point where you can take those benefits. Finally, we've got personal pensions. These are the ones you set up yourself, giving you more control but also more responsibility. You need to actively manage your contributions and investments. The general name for these are defined contribution pensions. So the key here is understanding the differences and maximizing what each type of pension offers. You don't want to leave anything on the table when it comes to securing your future. Now let's talk about some of the major concerns people have about pensions today. Well, one big issue is longevity risk. Now people are living longer than ever, which means your pension generally will need to stretch further. You definitely don't want to risk running out of money in your later years. Another concern is low returns. Now pension investments have faced challenges in recent years due to global global economic conditions, raising questions about whether they're growing fast enough to secure a comfortable retirement. Then there's the matter of accessing your pension. You can currently start taking money out from age 55, but this will rise to 57 from April 2028, but that mainly affects those born after April 1973. It's crucial to manage withdrawals very carefully to avoid running out of money too soon. And unfortunately, pension scams are also still a real threat. Too many people have fallen victim to fraudulent schemes that promise huge returns, but they end up actually wiping out their savings completely. So in short, understanding these key issues lays a strong foundation for very smart retirement planning. So are there any actual benefits of having a pension? Well, of course there are. Let's talk about one of the most underrated benefits of pensions: employer contributions. Well, for starters, employers now have to offer a workplace pension, and if you join and you pay in 5%, your employer will pay in 3% into your pension. Now, sometimes on top of that, your employer will match any extra contributions you choose to put in, generally up to certain maximums, of course. So here's an example. Let's say you earn £30,000 a year and contribute an extra 5% to your workplace scheme. That's £1,500 a year. Now, if your employer matches it, that's another £1,500 a year going into your pension pot. Now that's free money, and you'd be walking away from that if you don't take advantage of any matching available. And here's where pensions really shine: tax relief. This is one of the most powerful and often forgotten about benefits of saving into a pension. As a basic rate taxpayer, if that's 20%, for every £80 you contribute, £100 goes into your pension. The government adds 20 quid in tax relief. Now higher rate taxpayers, that's 40% as at the time of recording, they receive an uplift of almost 67% of their original net contribution. Now if you're an additional rate taxpayer, that's a 45% as at the time of recording, you could see an uplift of up to 82% in total value when you claim tax relief. This isn't just a small perk, folks, it's the government essentially giving you extra money to invest in your future. When you combine this with employer contributions and long-term growth, it's really clear pensions aren't just for saving, they're a tax-efficient wealth building tool. Now let's dive into the autumn budget 2024 and how it's changing the pension landscape. The 25% tax-free lump sum rule is staying, which means that when you retire, you can still access a quarter of your pension pot without paying tax. This is a huge advantage, but it's only beneficial if you've built up a large enough pot. The state pension rose by 4.1% in April just gone, and whilst that sounds great, it won't necessarily keep up with inflation. The state pension only covers basic living costs, of course, so if you want to maintain your lifestyle, you do need more than just the state pension. From 2027, pensions will be included in your estate for inheritance tax purposes unless the rules change, because it's not confirmed either way yet. This is a big shift, as for years, pensions were a way to pass on your wealth tax-free. If you want to protect your legacy, you'll need to rethink that strategy potentially. Right, let's talk about national insurance contributions, because these went up again in 2025. That does, however, make salary sacrifice schemes even more attractive. By sacrificing your salary for increased pension contributions, both you and your employer will pay less national insurance. These changes make the pension landscape more complicated, and if you're not paying attention, you could easily miss out on opportunities, or worse still, lose money. So seriously, folks, if you're not sure, seeking financial advice is absolutely crucial. There's a link in the description below. Check it out and make your own mind up. Now, pensions aren't a set it and forget it kind of thing. The rules change, the economy shifts, and your personal goals should evolve. The more you understand the system, the better decisions you can make. If you treat pensions as an old school passive investment, you'll probably fall behind, but if you take advantage of tax breaks, maximize employer contributions, and adapt to the new 2025-26 rules, you'll definitely be in a stronger position for your retirement, which is what we want for you. Now in 2025, the answer is still yes. Pensions remain one of the smartest ways to build your retirement wealth, but they only pay off if you use them wisely. Employer contributions, well, that's free money on the table. Tax relief, an immediate boost to your savings, and compound growth, well, it quietly multiplies your efforts over time. The updated rules offer greater flexibility, but also demand demand more vigilance. More options mean more chances to cock up if you're not actively engaged. The bottom line, pensions aren't a magic potion. Without consistent saving, smart investment choices, and a plan that goes beyond the state pension, you do risk falling short when it matters most. So now that we've tackled whether pensions are still worth it, what's the next big question? Should you throw everything at paying off your mortgage, or could investing give you a better return in the long run? It's a decision that can shape your financial future, and in our next video, we're going to break down the pros and cons to help you make the smartest choice for your situation. So click here to watch, and I'll see you there.